You already know about the $10,000 rule. You have heard people say that the government gets notified when you deposit more than $10,000 in cash. And maybe you thought to yourself, okay, I will just keep my balances lower than that. I will stay under the limit. I will keep things simple, stay off the radar, and never have to worry about the IRS knocking on my door. Here is the problem with that plan. It is 2026 and the game has completely changed. The $10,000 rule that people have been talking about for decades, that is no longer the most dangerous trap sitting inside the American banking system. There is a new trap now, one that is smarter, quieter, faster, and more powerful than anything that came before it. And the terrifying part is that millions of Americans are walking directly into it every single day without having any idea it exists. The IRS is now running over 126 artificial intelligence systems that scan your financial life, your deposits, your withdrawals, your Venmo transfers, your Zelle payments, your spending habits, your tax returns, and cross-references all of it in real time. They have fewer human agents than ever before, but their technological reach into your financial life has never been greater. And if you are still thinking about this the old way, just stay under $10,000 and you are fine. You are already behind. Today, we are going to cover everything. The old rule, the new trap, the AI system hunting for mismatches, the payment app danger most people have completely missed, the civil asset forfeiture horror stories that prove this is not theoretical, and exactly what you need to do right now to protect yourself. Let us get into it. Before we get into what is new and dangerous in 2026, let us establish the foundation, because a lot of people have a fuzzy understanding of the original $10,000 rule, and the gaps in that understanding are exactly where the new traps get you. The $10,000 threshold comes directly from the Bank Secrecy Act, a law enacted in 1970 and updated by the Patriot Act in 2002. Under this law, every U.S. financial institution, banks, credit unions, and money service businesses must file a currency transaction report, known as a CTR, with the Financial Crimes Enforcement Network, or FinCEN, for any cash transaction exceeding $10,000 in a single business day. This applies to deposits, withdrawals, and currency exchanges. The original threshold was $5,000, and Congress raised it to $10,000 in 1984, where it has remained for over 40 years. NerdWallet. When a CTR is filed, it captures your full name, address, social security number, account numbers, the amount of the transaction, and the type of transaction. The bank must file this report with FinCEN within 15 days. NerdWallet now. Here is the reassurance that matters. Depositing or withdrawing over $10,000 in legal money is not a crime. It does not automatically trigger an investigation. It does not mean an IRS agent is on the way to your house. The report is filed not because the bank is necessarily suspicious of you, but because large amounts of cash changing hands could indicate possible illegal activity. It is a routine data point collected by the federal government. Nothing more and nothing less, as long as your money is clean and your taxes are accurate. Visa Verge. But here is where so many Americans make their first critical mistake. They hear $10,000 triggers a report, and they think, I will just make sure my deposits never reach $10,000. I will split them up. I will stay at $9,500. I will do $4,000 here and $5,000 there. Problem solved. That thinking is not just wrong, it is a federal felony, and it is one of the most common financial mistakes innocent Americans make, often without realizing they have done anything illegal until the day the government shows up and freezes their accounts. We will cover that in detail in a moment, but first, let us talk about what the government has built in 2026 that makes the old $10,000 conversation almost irrelevant. What is happening right now with the IRS is genuinely unlike anything that has existed in the history of American tax enforcement, and the most recent government data makes it impossible to ignore. As of a March 2026 report from the U.S. Government Accountability Office, the IRS is now running 126 active artificial intelligence applications across audit selection, fraud detection, taxpayer services, and operational workflows. That number stood at just 10 in August 2022. In 4 years, the IRS went from 10 AI systems to 126. Milikowski tax law. The IRS has also begun deploying artificial intelligence to detect fraud in real time during the return filing process itself, flagging emerging compliance threats as returns come in. The criminal investigation function uses AI tools, including systems developed by Palantir, to process suspicious activity reports and identify compliance patterns at a speed that previously required many hours of agent work per case. Milikowski tax law. AI has been incorporated into the IRS's discriminant function system, known as DIF, which uses an algorithm based on a massive database of returns and a specific scoring formula. The goal is to identify returns with the highest potential for inaccuracies and discrepancies between income and deductions. Returns with higher DIF scores are selected for closer review to determine if an audit is warranted. Internal Revenue Service. Here's what makes this genuinely different from anything that came before it. The IRS uses bank deposit analysis to identify potential unreported cash income, directly comparing your bank deposits to your reported gross receipts and investigating any discrepancies. In 2026, the IRS now operates over 125 AI and machine learning models specifically designed to analyze returns, detect anomalies, flag fraud, and prioritize enforcement. And despite significant staff reductions, the agency is operating with roughly 77,000 employees, down from over 100,000. Its technological capacity to identify audit targets has actually expanded. Read that again carefully. Fewer human agents than ever before, but more technological power to find you than ever before. The IRS has essentially replaced thousands of human investigators with AI systems that never sleep, never take breaks, and can cross-reference millions of data points simultaneously. The IRS's new compliance analytics framework uses artificial intelligence to spot mismatches across returns instantly. Even if officials describe it as a tool for balanced enforcement, for most ordinary taxpayers, it means an automated review system that can flag your return without a single human being ever looking at it. And taxpayers are not told how the system works. The IRS does not publish the precise rules, model weights, or thresholds it uses to score every return. It will not tell you how or why it selected your return for review. You should assume the IRS can test your return against exponentially more data points than any human reviewer could process manually. This is the new trap. It is not a single rule with a single threshold that you can memorize and avoid. It is an intelligent, adaptive system that looks at your entire financial life, your deposits, your spending, your payment apps, your tax returns, and scores everything for risk. And if anything does not add up, it flags you, automatically, instantly, without warning. Now let us talk about the piece of this puzzle that is catching millions of Americans completely off guard in 2026. And it involves the apps you probably use every single week without giving them a second thought: Venmo, PayPal, Zelle, Cash App. These apps have become as natural as sending a text message. You split dinner, you pay back a friend, you collect rent, you get paid for a small job. It feels completely casual. It feels completely private. It is neither of those things. For years, the federal government was threatening to crack down on digital payment apps to catch unreported business income. In 2026, those threats have officially become a high-tech reality as the IRS has deployed new AI-driven systems specifically designed to flag inconsistent transfer patterns from these apps. Office of the Comptroller of the Currency. The passage of the One Big Beautiful Bill Act in late 2025 actually raised the formal reporting threshold for apps like Venmo and PayPal back to $20,000 in transactions and 200 transactions per year. This caused a lot of people to relax and assume they were off the hook. Tax experts are now calling this a quiet audit trap, because the lack of a formal reporting form does not mean the IRS is not watching. It just means they are not telling you they are watching until they send you the audit notice. Office of the Comptroller of the Currency. The IRS is now using what are called lifestyle indicators, analyzing your bank account to find income that does not align with what you have reported. If your bank account shows a steady stream of digital payment deposits that you have labeled as personal, but your spending habits suggest you are running a small side business, the new AI systems will flag the discrepancy. Office of the Comptroller of the Currency. And the situation with Zelle is particularly important to understand. The IRS views Zelle transfers as the digital equivalent of cash. While Zelle itself will not send you a tax form, your bank is still required to report suspicious activity or large cumulative transfers that flow through accounts connected to Zelle. Office of the Comptroller of the Currency. The IRS is clear on one fundamental principle. It only taxes income. It does not tax gifts, and it does not tax personal reimbursements. If your roommate Venmos you $800 for their half of rent, that is not taxable income. If your sister sends you $1,000 as a gift, that is not taxable income. But if you bake custom cakes and a client Venmos you $150, that is business income. If you walk dogs and get paid through Zelle, that is taxable compensation for services. Those are fundamentally different situations, and the new AI systems are specifically designed to tell them apart. Flag right. The danger is that the line between personal transfer and business income is one that millions of Americans are blurring every single day. Someone sells items online and collects through PayPal. Someone does occasional freelance work and gets paid through Venmo. Someone runs a small cash business and receives payments through Zelle. None of them think of themselves as business owners with reportable income. But the IRS's AI systems are watching the patterns, and if the numbers do not match your tax return, you will be flagged. Now we come to the most explosive part of this entire conversation. Because the AI is not the only new danger. The old structuring laws are still on the books, and they have ruined the financial lives of completely innocent Americans who simply did not know the rules. Here is how structuring works. The law says that if you deliberately break up transactions to avoid the $10,000 reporting requirement, making deposits of $9,500 or $8,000 or $4,000 twice in 1 week, specifically to avoid triggering a currency transaction report, that act itself is a federal felony. Not the money, the pattern. It is a federal crime regardless of whether the underlying funds are completely legal. The money can be entirely clean, earned through honest, hard work, and you can still face up to 5 years in federal prison and $250,000 in fines based solely on the pattern of how you managed your deposits. NerdWallet. The stories of innocent people destroyed by this law are extraordinary and deeply troubling. Andrew Clyde was a U.S. Navy veteran and the owner of a licensed firearms business in Georgia. In April 2013, the IRS seized his entire business bank account without charging him with a single crime. The reason was that he regularly deposited several $1,000s of cash from his legitimate business in amounts below $10,000, because that was simply the nature of his cash flow. The IRS originally seized nearly $950,000 from his business. He eventually had to forfeit $50,000 and spend over $100,000 in legal fees just to get back most of his own legally earned money. Thesaverge. Jeff Hirsch, who ran a legitimate convenience store distribution business on Long Island, had over $400,000 seized by the IRS for alleged structuring. Randy Sowers, a dairy farmer in Maryland, lost $29,500. Neither man was charged with any underlying crime. Their money was simply taken by the government, and they were left to fight through the courts to get it back. The Motley Fool. According to the Institute for Justice, from 2005 to 2012, the IRS seized more than $242 million in more than 2,500 cases for suspected structuring violations. And 4 out of every 5 of those forfeitures were civil, not criminal. That meant the government did not need a criminal conviction to keep the money. The owners had fewer legal rights in the fight to recover it. And the average case took nearly a year to resolve. Modern Treasury. Perhaps the most damning data point in the entire report. Nearly half of all the money seized by the IRS in structuring cases was never ultimately forfeited, suggesting the government took far more than it could actually justify keeping. Modern Treasury. Now add the IRS's new AI capabilities on top of this existing legal framework, and you begin to understand the full scope of the danger. In 2025, suspicious activity report filings hit record highs. Banks specifically flagged transactions below the CTR threshold as one of the top reported categories of suspicious activity. That means banks are actively watching for and reporting to the government the exact behavior, repeated deposits just under $10,000 that most people mistakenly think keeps them safe. SoFi. The bottom line is this. There is no staying under the radar by keeping your deposits under $10,000. That behavior is itself the red flag. Given everything we have covered, what does the IRS's AI actually look for in 2026? Understanding the specific triggers is the most practical thing you can take away from this video. The IRS uses bank deposit analysis to directly compare your deposits to your reported gross income. If your bank shows significantly more money coming in than you declared on your taxes, that discrepancy is an immediate red flag. This is the most fundamental and most commonly triggered alarm in the entire system, and it catches people across every income level. PIMPs. Businesses that deal primarily in cash, restaurants, salons, barbershops, food trucks, and similar operations, attract heightened scrutiny because cash is harder to trace. Significant or persistent losses reported on Schedule C can also prompt the IRS to suspect underreported revenue or improper deductions. Missing or inconsistent information is also a major trigger. If the IRS receives third-party data from employers, banks, or payment platforms, W-2s, 1099s, bank interest statements, indicating you earned income that does not appear on your return, that mismatch can trigger an immediate automated notice or audit. Transfers over $600 tied to payroll, vendor payments, or client invoices through business bank accounts may trigger reviews if they differ from established patterns. Banks are required to verify that business accounts are not being used for personal transfers or unregistered commercial activity. U.S. News and World Report. And now, in 2026, all of this analysis happens at machine speed. The AI does not need months to build a case. It identifies the pattern, scores the risk, and routes the file to the appropriate enforcement channel, all before you have even finished your morning coffee. After everything we have covered, the path forward is clear, and it starts with one foundational principle. In 2026, the only truly safe financial strategy is complete transparency. Never, under any circumstances, break up deposits or withdrawals to stay under the $10,000 threshold. As we have established thoroughly, this is not a clever workaround. It is a federal felony with severe penalties, and banks are specifically trained and algorithmically equipped to detect it. If you have a large cash sum to deposit it all at once. Be open with your bank about where it came from, and let the routine currency transaction report be filed. That single, transparent transaction is infinitely safer than a pattern of smaller ones. Make sure your bank deposits match your reported income. This is the fundamental check at the heart of the IRS's AI systems. If you have legitimate reasons for a gap, a one-time sale, an inheritance, insurance proceeds, document everything thoroughly and make sure it is properly reflected on your tax return. If you are a small business owner, be especially careful about how you handle cash flow and digital payments. Transfers tied to business activity that differ from established patterns can trigger bank reviews, even at amounts well below $10,000. U.S. News and World Report. For your payment apps, label every transaction accurately. If something is a personal reimbursement, make sure it is clearly documented as such. If something is business income, report it. Keep a running record of every business transaction, the amount, date, and purpose, because the absence of clear documentation is itself a risk factor in an audit environment driven by AI pattern recognition. Flag-right tax experts are now advising taxpayers to proactively review their returns for potential discrepancies, evaluate the strength of their existing documentation, and consider whether amended returns or protective filings are warranted, especially for open years not yet under audit, since the IRS's AI tools are identifying non-compliance issues in filed returns on an ongoing basis, not only at the point of initial filing. Institute for Justice. And if you ever find yourself facing a government inquiry about your banking activity, do not try to handle it alone. Engage a tax attorney or enrolled agent immediately. The stakes are simply too high to navigate without professional guidance. Here's the truth that brings all of this together. The $10,000 rule that everyone has been talking about for decades was never the whole story. It was always just the most visible piece of a much larger surveillance architecture built around the American banking system. And in 2026, that architecture has been upgraded with artificial intelligence, real-time data cross-referencing, payment app monitoring, and AI-driven audit selection systems, all operating at a scale and speed that no human enforcement team could ever match. The IRS went from 10 AI systems in 2022 to 126 active AI applications in 2026. That is not incremental change. That is a transformation. And every American who earns money, keeps a bank account, uses a payment app, or files a tax return is operating inside that new reality, whether they know it or not. Milikowski Tax Law. The trap is not just keeping $10,000 in one account anymore. The trap is any pattern that tells a story your tax return does not support. Any behavior that looks like you are trying to hide something, even if you are hiding nothing. Any gap between what flows into your bank and what the IRS can see on your return. Knowledge is the shield. Transparency is the strategy. Documentation is the proof. Use all three, and share this video with anyone you know who still thinks simply staying under $10,000 is enough to keep them safe. Thank you for watching. Stay informed, stay protected.